Welcome to this explainer. Today we're diving headfirst into the irresistible allure and, honestly, the somewhat hidden dangers of single-stock synthetic ETFs. Look, if you spend any time scrolling through investing forums or financial social media, you've definitely seen these funds popping up everywhere. They are flashy, they're generating a massive amount of buzz, and they promise something that feels almost too good to be true. Massive, double-digit income from growth stocks that typically pay little to absolutely zero dividends. But as we all know, in the financial world, there is no such thing as a free lunch. So we're going to break down exactly how these funds operate under the hood, what their own prospectuses actively warn you about, and most importantly, what the actual data shows us about their real-world performance. Let's get into it.
Okay, we've all seen the massive numbers floating around online, right? I mean, 66.88%. When you're used to seeing a traditional, boring dividend stock pay out maybe 3 or 4% a year, seeing a number pushing 67% next to an ETF's ticker symbol is designed to make you stop dead in your tracks. It literally feels like an absolute cheat code to building wealth. And this enthusiasm, it is everywhere. You go on forums like Reddit, and income chasers are just throwing money at these seemingly magical funds. Take a look at the sentiment from users like VivaLaw_Adam. When you're staring down yields pushing past 60%, paying a management fee of roughly 1% feels like an absolute bargain. People are practically begging these fund managers to just take their capital, completely drawn in by the promise of those colossal monthly payouts.
But hold on a second. What are the actual risks lurking beneath these massive yields? Because while the cash distributions hitting your account are very real, the mechanisms they use to generate that cash come with a highly unique set of trade-offs. And honestly, it's a structural reality that every single investor needs to thoroughly understand before even thinking about hitting that buy button.
Section 1. The high-yield allure. Seeking income from non-dividend tech. The core appeal here makes total sense, right? You want massive monthly cash flow, but you also want it from massive, world-changing growth stocks like Apple. You want the best of both worlds. Well, funds like Kurv's APY and YieldMax's APYL have stepped right up to offer exactly that. They charge management fees of around 1% to do all the heavy options lifting for you. APY sits at 0.99% and APYL at 1.06%. For your average retail investor who doesn't have the time, the capital, or the, frankly, complex expertise to actively manage an options portfolio every single day, outsourcing that massive headache sounds like a total steal.
Moving on to Section 2, Mechanics of Synthetic ETFs, the Magic Engine.
So the big question, how do these funds magically generate double-digit income without just buying and holding millions of shares of the stock? Well, they use what's called a synthetic covered call strategy. Let me break that down in plain English. First, they create a fake or synthetic long position in the underlying stock, in this case Apple, using derivatives. This essentially mimics owning the stock outright. Then they write or sell call options against that synthetic position. By selling those call options to other people in the market, the fund collects upfront cash. We call those premiums. And those premiums? That is what ultimately gets paid out to you as those massive monthly distributions. Now, while the underlying engine is exactly the same, different funds tune their strategies a bit differently. Kurv, for example, tends to sell monthly options that are about 10 to 15% out of the money. This focuses a bit more on hedging and actually gives the stock some room to breathe and grow. YieldMax, on the flip side, favors closer weekly options, typically just 5 to 7% out of the money. That requires almost daily hyperactive adjustment to their positions. But regardless of whether they're playing the weekly or monthly game, both are generating income by doing the exact same thing. They are literally selling away the future upside of the stock.
Section 3. Capped gains, full downside. The structural catch.
Okay, so here is the crucial trade-off to this whole strategy. It's simple, but it is brutal. These funds cap your potential gains during a massive tech bull run, but they leave you exposed to the entire downside if the underlying stock plummets. Think about it. You cannot generate double-digit yields out of thin air without sacrificing something. When they sell a call option, they are fundamentally agreeing to cap their profits at a very specific strike price. So if Apple stock suddenly moons and jumps 20% on a killer earnings report, the ETF does not get to participate in all that upside. The gains are hard capped. But if Apple stock completely tanks and drops 30%, the fund's synthetic position takes the absolute full brunt of that 30% hit. Ouch. And look, they aren't hiding this. Their own legal documents are incredibly transparent. If you read the prospectuses, they actively warn you of single issuer risk, meaning your entire investment hinges on the success or failure of just one single company. They warn you of derivatives risk, explicitly noting that options can be highly sensitive to volatility and time decay. They mention active management risk, which is just a fancy way of saying the fund managers might just make the wrong bet.
And perhaps most critically, they explicitly state that principal loss is very possible. If the underlying stock drops, the income you get from those option premiums might not even come close to offsetting your massive capital losses.
Section 4. The return of capital trap. The dividend illusion.
This structural catch actually builds into an even bigger, scarier problem for your portfolio's actual value. Sometimes, these funds are desperate to maintain that high, flashy monthly payout to keep investors happy, even if their option strategy didn't actually generate enough pure profit to cover it that month. When a fund pays out cash that exceeds its profits, it gets classified as a return of capital, or ROC. What does that actually mean? It means they are literally handing your own initial investment money right back to you. Now, sure, this defers your taxes by lowering your cost basis, but it actively and slowly erodes the fund's net asset value over time. You are literally cannibalizing your own principal just to get a monthly check in the mail.
And retail investors who are paying close attention, they are totally catching on to this illusion. Just listen to what Reddit user Hoffman Unfiltered points out. Unless you are constantly, religiously reinvesting those massive dividend payouts right back into the fund, your initial capital simply bleeds away. They rightly call it a yield trap. If the underlying stock hits a rough patch, that erosion of your principal can happen incredibly fast, leaving you holding a bag that is just a fraction of your original investment.
Finally, Section 5. The total return reality. The data showdown. To really understand why all this matters, we have to look completely past that flashy distribution rate and focus on the absolute hero metric of all investing: total return. Yield is just one tiny piece of the puzzle. Total return is what actually dictates your wealth. It's the combination of the price changes of the ETF itself, so your capital appreciation or depreciation, plus all of those juicy dividends perfectly reinvested back into the fund. This is the only true, honest way to measure if your investment is actually growing your wealth.
And honestly, when you crunch the numbers, the reality is absolutely staggering. Let's look at a performance analysis tracking a hypothetical investment from October 2023 through July 2026. Assuming every single dividend was reinvested, a $10,000 investment in standard, boring old Apple stock grew to over $20,000. Meanwhile, that exact same 10 grand invested in the synthetic funds severely underperformed despite having those massive headline yields. APY grew to just under $16,900, and APLY only made it to about $15,700.
The exact numbers just make the reality undeniably clear. The underlying Apple stock delivered a massive 100.9% total return. That is an annualized return of over 29%. The synthetic strategies AAPY and AAPLY, they lag significantly behind at roughly 68% and 57% total returns, respectively. Because their upside was continually capped every single time Apple's price rallied, they just couldn't keep pace. You're basically giving away the tremendous growth of one of the world's best companies in exchange for an immediate but mathematically less profitable cash payout.
So as we wrap up this explainer, you really have to look at your own portfolio strategy and ask yourself a tough question. Are those double-digit yields actually building your long-term wealth? Or are they just a really expensive illusion, masking capped upside on the slow, painful erosion of your own capital? Income is fantastic, but not if it costs you your principal to get it. Thanks so much for joining me on this deep dive into the risks behind synthetic ETFs, and I'll catch you in the next explainer.